Muamalat and Rhb Islamic Bank are significantly concerned about credit risk given the diverse financing products they offer to consumers. In this case, credit risk means the possible loss of money that banks face when the customer can't pay back their loans. Credit risk must be managed and reduced effectively for these banks to stay stable and make money. So, these are the factors for these two banks manage their credit risk. The first one is risk evaluation and insurability determination. Each bank uses thorough risk assessment and screening process to lower credit risk. During these steps, borrower's reputation is carefully determined. For example, banks look at the borrower's income, credit history, and other important financial indicators to decide if the borrower is affordable for the insurance or for the loan. Failure to do these things correctly can lead to more defaults, which increases the bank's total credit risk. Secondly, economic factors and credit risk. The economy is one of the most important factors that affects the credit risk that banks face. When the economy is unstable, it makes it harder for people to pay back their loans. There is a higher chance that borrowers will not be able to make their payments during times of economic recession, high unemployment, or problems unique to certain businesses. As a result, this outside economic factor make credit risk more volatile and force banks to constantly change how they handle risk. The third one, collateral and security measures. Bank often ask for collateral and protection for certain types of loans in order to lower the risk of default. To protect the bank in case the user doesn't pay back the loan, collateral is used. However, how well this approach works to lower risk depends on how much and how well the collateral is worth. Because the bank is taking on more credit risk, the collateral may lose value over time or not be enough to cover the loan amount. This shows how important it is for banks to manage collateral carefully as part of their total risk reduction plan.
Hi and Assalamualaikum. I'm Nur Akidah Najah binti Muhammad Rafi. Okay, so I will talk about the operational risk. Okay, the product that have been produced by Bank Muamalat and Rhb Islamic Bank must have the risk toward the product. The product risk can happen due to lack of marketing of a product or service that can make the bank have potential for losses to generate profit from the product. Okay, the operational risk is the risk and uncertainties a firm must deal with in order to conduct its regular business operation that have a probability of loss. The factor that can causes operational risk are the internal and external factor. Okay, the internal factor is due to employee shortage or inadequacy in the organization, while external factor are a third party breaking the term of a contract and natural disaster. The operational can happen if the organization of the Bank Muamalat and Rhb Islamic Bank of them did not overcome the problem in the management. Therefore, the way to solve and or avoid the product risk when Bank Muamalat and Rhb Bank produce the product is they need to identify, track, control and monitor risk to manage the product risk.
Hi, my name is Fatia Usna, number matric to A0494. I will continue the presentation about the liquidity risk. Liquidity risk pertains to the potential for a bank to lack sufficient cash or easily convertible asset to fulfill its financial commitment when they become due. In terms of depositor behavior, when sudden and large withdrawals by depositors may put significant pressure on a bank's liquidity situation. In the event of a large-scale withdrawal of money, a bank may have difficulties in fulfilling this request if it has sufficient liquid reserves. Furthermore, there is an asset liability mismatch. Financial institutions allocate funds to diverse assets with varying duration, although obligations such as deposits may pose short-term time frames. If a bank's assets have lower liquidity compared to its liabilities, it may have difficulties in converting its asset into cash in order to fulfill short-term commitments. Lastly, bank depends on interbank lending and accessing financing markets to effectively manage their liquidity. A bank's capacity to maintain sufficient liquidity might be impeded by constricting credit markets or borrowing challenges.
Okay, for the market risk part, will be effect on the first thing is financial, where the market risk refer to the potential financial losses due to the market fluctuation, and the second one is will be effect on the interest, where the both bank face significant interest rate risk due to the risk due to their exposure to variation in the interest rate. Fluctuation in the interest rate can affect the value of fixed income asset and loan portfolio and the cost of acquiring funds. The third is exchange risk, where the Exchange risk arise when the bank have investment or loan denominated in the other currency. The last effect is commodity price. Commodity price risk is concern for the bank that invest in or exposed to the commodities.